overall, let's just start and dive right through all of this. So all of this pretty much is, and all of the things I'm gonna overall talk about today is gonna be heavily based on my playlist Become a Goat. So if you haven't already watched all of that previous lectures, I would highly recommend you to start by doing it right now. I will also make sure to overall link it. So if you have not watched this yet, I would highly recommend you to start doing it. This talk will overall incorporate 4 different subsections, and we're gonna start off by looking at the news to establish an foundation. So looking at the Monday here, what you all pretty much can see is that we have a pretty boring Monday with not many news events, only exception being the Canadian news, which releases at 14:30. And so this is also an December month. What I more or less think will happen, and during this call we're going to talk more generally about the whole later stages of this year, but also the beginning stages of next year. So this will be more or less incorporating my perspective of what me personally think will happen during the month of December or later stages of December, but also the beginning and later stages of August or of January. So looking at the Tuesday here, what you pretty much can see is a pretty boring Tuesday with a lot of bank holidays, but also a bank holiday for Australia and New Zealand. You, however, don't see any bank holiday for the Americans. However, I will avoid trading Tuesday. And I think I forgot to mention that on Monday I possibly could trade. However, it depends on how the market conditions look and in which form Asia range releases. So looking at Wednesday here, Wednesday is a day I will definitely stay out of. I think it's going to be a consolidated range day. So I don't think it's going to be highly probable to get any sizable moves in, and therefore I will just stay out of trading Wednesday. Thursday is another day, pretty much I think we're going to be heavily consolidated, even though we have the 14:30 news release. I think we might just stay out of the markets. And Friday here as well, where Friday could be a given day as Monday. If we overall, or if I notice we have good market conditions on any asset, I will maybe and potentially take a given trade on Friday. So like I said, this call consisted of 4 individual parts. Therefore, we will go in and talk about seasonalities, COT, the DXY, and the given asset you're trading. Now, you will also have noticed that this is pretty much the outline I follow when I'm actually trading. So, as we have already established in the previous lessons or lectures, I usually start by looking at the news events, establishing a foundation of where and where not I will trade, but also pretty much how the news will overall influence the market, be it trading conditions, market conditions, and things of that nature. This is the rest of the things I'm looking at. So after I've already established the news events, I'm overall trying to establish in which direction the markets will move, aka my bias. So I get the narrative in, so then I can establish in which direction I will overall trade in. and look for my model to occur in. Therefore, I'm also establishing areas of interest in which I'm looking for my model occurring. Thereby, I then look at seasonalities, COT, the DXY, the given asset, the DXY, and the given asset I'm trading, in this case Euro USD. So going and looking at seasonalities, what you all pretty much will notice is that the month of December for the DXY usually is bearish. It usually goes lower. However, this has not been the given case, as you already can see. Therefore, I'm thinking the seasonalities in this case are actually lacking a little bit behind. I will go in and talk a little bit more about this in the later stages of January. As just note that the seasonalities will actually change. They will change because that every year new data gets added, and it pretty much gets added, and it will change the given data which has already gotten established, because the seasonalities is literally calculated by the average amount of movements in a given period. In most cases, week by week or day by day, and then pretty much placed like this, so you get more or less like a graph of the given price movements in percentages. But usually the December month for the DXY usually is bearish. In this case, it has not been bearish. Therefore, I think we're going to see the bearish tendencies or seasonal tendencies be bearish during January. And as you can see, at the start of January, the 20, 15, 10, and 5 shows that we should see lower prices for the DXY. Now, I used those and excluded the 2-year-old, as the 2-year-old pretty much is the newer data, which only consists of 2 later stages of data sets. So you have the last January, not this year, but the one prior to that. But you also pretty much have the January prior to that one, which then pretty much you average out and you get this one, meaning it's the least favorable to use because it will also change after January. And after January, I think the 2-year-old dataset will also be aligned with the rest of the datasets. Therefore, I'm looking for lower prices for the DXY from January to February, at least. Now, during market conditions where the seasonalities is not perfectly aligned, you will notice market conditions being a little bit worse. So when the 20, 15, 10, 5, and 2 does different things, price will tend to be a little bit worse in terms of good market conditions, meaning you will experience worse market conditions than you usually trade in. And the arrow right there is just showing a clear example of when price could be in a worse position, which is usually is during January and December. Now, during periods where all of the given datasets is aligned, that's periods where you might see good market conditions. Just note that this dataset will change after January, because this year's data will be added into market bulls seasonalities. Looking out at the COT program for the American dollar, which is something I usually as well include in my videos, you will pretty much find the commercials focusing in on this part specifically, and this is pretty much the only thing in the COT you need. You don't need to look at any of the given numbers. You don't need to look at any of the other graphs or charts. The only thing I'm particularly focusing in on is the legacy net and the price chart. That's the only thing you need, I would say. Now, when you have pretty much come to a more advanced level, you could specifically also focus in a little bit more on open interest, which could come in hand in specific times, which I've covered in previous lessons and I will cover in the future. So let's just focus in on this a little bit. As you can see, with the arrow pointed towards the commercials, actually starting to sell a little bit. This is just noting prior to the DXY already sweeping the previous monthly high, which you could see is the top left right swing high. So we have now traded above that and the commercials is starting to sell. Now focusing in on a little bit more of an in-depth view of the legacy net, what you will be able to see here is that we're now approaching the minus 10,000 line, meaning we're still in a bullish hedging program. However, they have just started selling, indicating a potential move toward the downside in the near future. So how do you then calculate it, and how can you then see if there is going to be a bullish hedging program or a bearish hedging program? Well, you pick out a time period. In this case, this is 1 year of data, and in that time period, as you can see, you pick out the low point of the dataset, which the arrow is pointing towards right now, and pick out the high point of the dataset, and you divide them by 2. If you overall have divided them by 2, you can see the low point being the minus 20,000 line, while the high point being a little bit above the 0 point. I would say it's approximately 2,000. You can see that we get overall a line ranging from more or less the minus 9,000. So you take the low point of the given data set in terms of numbers, and you take the high point in data set in terms of numbers, and you divide them by 2, drag the level out, and the levels above the given line, which you overall get, or which you overall have calculated, is the bullish hedging program, and everything below is the bearish hedging program. I showed you a clear example of this, so let me just demonstrate it here pretty quickly. As you could see, when overall we moved to a bullish hedging program from a given bearish hedging program, we started seeing higher prices. And when we overall moved from a bullish hedging program, which we were in here, to a bearish hedging program, we started seeing lower prices. So what do you expect now? Well, you expect soon seeing the given lower prices here. So looking at the DXY now, focusing in a little bit more on the DXY, what you will be able to see is that we now more or less have a given data range. And what you also will be able to see is that we now have swept the given data range high, aka the previous yearly high. We have taken out that time-based liquidity and we're moving up towards our IPTA alignment. And the IPTA alignment is at 109.571, which we will later talk about. But you can also notice that we have equal lows in terms of previous yearly low and the previous original consolidation low, in which we will talk about the smaller market maker sell model later. Looking at this, you could also see a higher time frame market maker sell model. So given the confluences of the seasonalities being bearish from December, in which we're overall thinking December month has lagged behind, meaning we're thinking December will then become January and January will then become February, we should be bearish from January to February and February to the given March. Looking also at this, you could see an overall power of 3 or a higher time frame power of 3 where we have seen a consolidation range for approximately 2 years. We have also now started seeing price manipulating, and we're just waiting for the distribution phase in which we have the seasonalities and the COT soon starting to align. Now when they both pretty much goes into an agreement, you'll overall see quickly lower prices for the DXY following. Here we are just have a much more zoomed in version of the given US dollar index. You can pretty much see here the smaller market maker sell model here as well, where we have the original consolidation, a reconsolidation, and another reconsolidation taking the time-based liquidity. But also here you can see the previous swing high getting taken out by this term's high. And what I more or less think will happen is that we will rally into January the 2nd, and from January the 2nd, where time and price aligns, as January the 2nd is a quarter shift, now the real quarter series, where the central banks moves funds every 4 or 3 months, is actually the case. So you can see we have time aligning, but we also overall have the price in terms of the 109,536, which is an IPT alignment aligning. So we have time, price, COT, seasonalities aligning at that given moment, which then will most likely cause a reversal to happen. Looking at this in a much more focused manner, this is overall something I'm particularly keen on looking at. Just note that this is just my predictions of what I more or less think will happen. This does not necessarily need to happen. This is just my predictions. So please just follow your own predictions here. Now what you also could be able to do is just measure the 0 line to the 1 line, and you will also get a graded price swing. A graded price being at all the given numbers 0, 0.25, 0.5, 0.75, you will get overall entries. So at all of this given price, markets will give you re-entries or entries for the market maker sell model potentially forming in the future, reaching for the equal lows. Now, I potentially thought this would actually be the high. However, as the COT and seasonalities did not quite align with me, it potentially failed. But as the COT and seasonalities now hopefully will be aligned, as well as the externals, we may see lower prices in the near future. Looking at it from a quick Euro USD perspective, what I'm particularly keen on looking at is just the given high prices reaching for the buy side liquidity equal highs after taking the time-based liquidity, in which case we have done. You can see a small little level here, and that's the level low I'm looking for, as well as the time, and that's overall where I think the time and the price will align due to a quarter shift and an IPTA alignment, seasonalities and COT. Now zooming into this a little bit, this is just a much closer view of this, and you can see the reconsolidation as well as the much larger market maker buy model. Zooming into this once more, you can see the smaller market maker buy model. You can also see the buy side liquidity in the form of equal highs and last year's high, aka time-based liquidity. Looking at it from an 6 stage of distribution perspective, you can notice that the 20-day, 40-day, and the 60-day perfectly aligns with all the reconsolidations, some sauce, and is our drawn liquidities which we're looking for getting taken out. This is overall my perspective of what will happen. This does not necessarily need to happen. This is just pretty much what I'm looking for happening. Looking at it also from a perspective of the seasonalities, and as this is the Euro seasonalities, we know that we should be soon seeing higher prices, because if we're overall thinking the seasonalities is a little bit delayed, in which case I think they are. Aligning them perfectly will overall make us see the higher prices. As we're overall thinking, December month is in terms of uh, price delayed, you could say. So you could say, looking at it from November, December, you can see the reconsolidation down there. I think we more or less have already seen that. This is perfectly aligned. While the December month has been a delayed delivery towards the upside, after the quarter shift, I think we're gonna see the December price delivery toward the upside, as well as the February February um, as well as January February months being consecutive months of bullishness in the market, reaching for the alignments in terms of the buy side liquidity. As interesting, and I've shown you guys this perspective itself as well, where you can see all the given reports of COT. You could see in all of them that the commercials is actively buying up foreign currency and making large reserves of foreign currency. As my theory goes, I think the central banks are locking in the higher prices on the DXY, capitalizing on the historic lows of foreign currencies, now starting to overall buy up those foreign currencies in anticipation of a weaker dollar in the future. Looking at the Great British Pound, or GBP, USD, we can overall see the same thing happening where we have a higher time frame market maker buy model, while also of course having the SMT from the previous yearly low. I think GBP, and this is some other sauce, will be much more bullish than EUR/USD. So as soon as we have swept the time-based liquidity low of the swing low, I think we will see a total soup and just higher prices from there after the quarter shift. Same thing goes for the Australian dollar. I think this will be much greater, and we'll see a great move on AU compared to any other given assets. That was it for today. Hopefully, you guys really appreciated this call. Put a lot of effort into this call, and I will continue doing these calls rather than the ones I've done before, as these are much more planned and much more, I would say, concentrated in the content I want to provide. Thank you all so much, and see y'all. Continue having an amazing holiday, and Merry Christmas for the people celebrating Christmas. Thank you all, and see y'all. Bye.